Fears of an economic slowdown in China are panicking Chinese and global markets. Shares in the world's second biggest economy plunged 8.5% on so-called Black Monday, then almost as much again on Tuesday, extending the Shanghai Stock Exchange's steepest drop in almost 2 decades. It's a sign of continued jitters over China's management of its faltering economy.
It seems that the toolkit is starting to empty a bit, and that effectively the economy is not responding, or is responding insufficiently to stimuli that have been put in place by the authorities. And so this reinforces fears that the Chinese economy is slowing more markedly.
China is the world's top trading nation, but in recent weeks exports have fallen and manufacturing activity has stalled. A shock devaluation of the yuan 2 weeks ago was seen as an attempt to boost competitiveness.
There was basically only one strategy in the market, and that strategy was to ride the government-supported bubble. And when there's only one strategy among investors, then the market becomes incredibly difficult to predict and incredibly volatile.
Monday saw $2.7 trillion wiped off shares globally, though European and US markets rebounded, and in Europe some politicians and economists are playing down risks of contagion. But with the US Federal Reserve expected to raise interest rates for the first time in a decade, investors remain on edge.
This is just a recovery of whatever happened yesterday, but there is nothing solid or fundamentally solid behind the move that we are seeing these days. It's mostly about uncertainties about the Chinese slowdown, but also the Fed expectations that are driving the market in this very chaotic fashion.
In an effort to calm the markets and boost growth, China has now cut its main interest rate again. All eyes remain on Beijing.